Good afternoon. This is Ken Long from Tortoise Capital, and I'm going to do some thinking out loud about swing trading from a conceptual framework. And the three main themes I want to talk about is, number one, the idea that there is a seasonality to be swing trading, or 'tis the season to be swing trading. And the second idea is that there is a place when price is at an extreme location in the current time frame that makes it poised to do something exceptional in the swing trade. And then the third, that this is the moment that we have the combination of the season and the moment and the beginning of price action, which allows us to set up a swing trade. So first thing I want to start with is the idea that 'tis the season to be swinging. So suppose that we have some kind of price action, and I've drawn an arbitrary box around two different sets of price actions, and we might ask, given some price action, can we compute the volatility of that time period and then compare it to its historical patterns, or compare it from one period to another? And the idea being that if volatility is related to success in swing trading, then if we can characterize the quality or the degree of volatility, of relative volatility in one time period or another, we might have a preference for when we want to be swing trading that instrument. In other words, is it the season in which swing trades are more likely to be useful? And so that makes us make an assumption about volatility and swing trading. You could take one position that more volatility should lead to better swing trading. When I say more volatility, I mean more daily volatility should lead to better swing trading. And then the second alternate assumption might be, what you want is directionality of a move. In other words, stringing together multiple days of movement more than volatility. My spider sense tells me that which assumption you would prefer is probably based on the time horizon that you have for holding. And my sense is that the shorter the holding period, the more that you favor volatility in a general sense. In other words, non-directional, could be up one day, down the other. You want more volatility the shorter the time holding is, so that you get the benefit of the big move quicker. Whereas the longer that you want to hold, the more directionality matters, as you're looking for ownership of that position for maybe a week or 10 days or 2 weeks or longer. The shorter holding time frame then, in my sense, would be better suited for swing trading one day at a time, where you might take a position intraday, and then if it works out favorably for you, use that to fund some overnight risk, and then hope to see some follow through on the second and third day, using market's money to accept the risk. Well, if all that makes sense, then what we're really looking for now is some way to describe the relative volatility of this time period here versus this time frame here. We might take, let's just call it 30 days. We might find what the maximum range percentage was during that 30-day time period by finding the high of the period minus the low of the period, dividing it by the price, and that would give us a max range percentage. And so we might say, if this time frame had a greater max range percentage than this time frame, then this one would be more volatile. In other words, the optimal move was greater as a percentage of price in the two different time frames. We might also use a statistics-based approach where we'd say, let me consider the width percentage of the Bollinger Band. In other words, we want to use the percentage in both cases because we want to normalize against price. We want to be able to compare apples to apples. Well, that really turns out to be the same thing as measuring the standard deviation of the 30-time period, the percentage, since the Bollinger Band width is simply a multiple of standard deviations. And so the formula for that would be the standard deviation of the 30 time frame divided by the price. I'm toying with the idea whether that needs to be average price or the most current price. I think it needs to be the current price, but I could be convinced of the average price. By the same token, we might just shorten it up a little bit more and use the ATR percentage. Now that's the treatment that I use when I'm computing market classification using SPY, and I have that in bundle number 2 called the volatility statistic, or the vol stat. And the idea behind those two, I don't know that there's that much difference between the two. My current preference would be leaning towards, I think, the standard deviation 30, just because it has a little more rigor in terms of statistical power. But the idea would be that if we could go back, let's call it 200 days or 210 days or 180 days, pick the time frame that matters, and we computed the volatility statistic for each one of those days. Let's just call it 180, since that's what I use in the vol stat. We might then compute the maximum, the minimum, the average, and the standard deviation of those numbers and come up with something like a volatility climate chart, in which we could say for that whole 180-day period that the average volatility percentage, or the SD percentage, the volatility statistic, is this central black line, and that we mark it off by maybe plus or minus 1 standard deviation and call that normal. And then if we had price that was up here in the swing area that I've labeled swing, we would have a volatility that was extraordinarily large compared to the historical norm, which should lead to large local short-term moves, maybe 1 to 5 days of movement as we get to some kind of crescendo for volatility. My sense is those would be great days to be culminating a swing position, because I think you're likely to see parabolic moves up in that range, because the momentum has developed and has culminated in an expansion move that then terminates. I think up in that area where it's labeled swings is the likely place to see parabolic moves, which is where you want to be preserving your swing moves. By the same token, if you were down here where I've labeled it as breakouts, this is something like the quiet portion of the sideways quiet channel. Now, it doesn't have to be directional or channeling, but my sense is that you've got such extraordinary lack of volatility that the next move out is likely to be a large one, or more likely to be a large one, and that will catch people by surprise, and that will generate some initial interest either in piling on the breakout or fading the breakout. So it seems to me that in this region, when you're down in the quiet, you're waiting for that first move and really looking to pounce early and capture the move early. Now, I've drawn 2 arrows in here that shows the path of volatility moving in an orderly fashion through the normal volatility channel, and I think that if you had something that was near the low end of normal, had gotten as quiet as it was going to be, and is now slowly starting to build volatility up towards this upper noisy end, that this is an area where you really are interested in swing trades developing, because I think that's where you're going to start to see range expansion and some directional moves is my spider sense. And then by the same token, I think you get a region that's bad for breakouts when you're back into the high end of normal and volatility is slowly collapsing and price is settling on the new normal. I think those are places where it's less likely to see good swing trades, because price has found its new level. That's my sense of how that works. And I'm thinking of the risk Z in this regard too, that when we see it has gone to an exceptionally low level and then started to roll back up, that becomes the moment when XIV is really excellent, and then where you want to be cashing and having a shorter term positions intraday when risk Z starts coming back towards the zero line. So that's how I think we could do almost like a weather pattern or a climatology study of a volatility of an instrument, and my sense is that the SD is probably the way to go, although I think ATR percentage could work as well. That seems to be relatively smooth in the S&P, and maybe that changes more quickly, so I'm going to set up something that does both of those. So if we can say that somewhere in here there's a way that we can start differentiating between periods of time to say one is more favorable for swing trading of a certain kind than another, we might now want to refine that and say when we are in the season, when it's planting time, when it's the spring, how can we refine the moment or when price is at a place where the swing trade is well done. So my sense is that we want to be looking for extreme conditions. In other words, price has moved to an extreme location in the time frame of interest. My first inclination is to use the Z-score. So where is it on that 30-day Z-score, with respect to the river and the floodplain? It could also, and I would prefer to see that extreme happening as it approaches a test of previous support and resistance. And now you have the power of statistics plus the power of support and resistance in chart reading. And then also it might we might be looking for something that is behaving like it is a turning point. In other words, like a price has slowed down as it comes to this test and is becoming a doji. I am open to some other definitions of what a working description of a turning point could be, but right now it seems to be, I have it centered on the idea of a doji. And so the third point then is if we combine point 1 and 2, that this is the moment for optimum swing trading, is that number one condition is that the long-term volatility season is favorable for relatively large moves, and number two, that the short-term price location is at an extreme. And then we can say to ourselves, what do we take as evidence that the minimum price action that defines a signal has occurred, or that we are ready to say that the move has started? So in the Z pattern trade, that's something that gets outside of Z minus 2 or Z minus 3 or Z plus 2 or Z plus 3 for that matter, and has moved a full standard deviation back towards the mean, that automatically sets up the 2 to 1. We might also say something like a 1, 2, 3 entry, or a price move of a certain magnitude, maybe that's not related to Z, but has taken out a support or a resistance level. And so this is where I think we can use price action and these criteria of using statistics and maybe Z-scores to define some swing trades based on trade location. So this is what a operational picture of that might look like if we had some indicator that gave us the Z-score of volatility, again, whether that's ATR percentage or the SD percentage, and we had marked off the plus or minus 1 and the long-term average. And then we've mapped out this little histogram, like a MACD histogram of volatility. In these areas where there are circles, this is where, I think the follow-through swing should be large, or if we were able to get into this early on the way up, that these are the places where the biggest payoffs are likely to occur at that peak of volatility where you see the parabolic moves. I think you should look at those as opportunities to ensure you're capturing major portions of the trade that you were in that took you up to that point. By the same token, that's also the sharp move back away from the parabolic move can be a nice on price collapse or the dead cat bounce. So we might then, so if we treated that as the seasonality component of this discussion, then trade location using the z-score would look something like this, that we have the average and then plus or minus 1, plus or minus 2, and you can see that the size of the river and floodplain is expanding. So BB expansion would be a normal thing to occur when this volatility expansion is happening. You mathematically have to see that. And then we would say, so if we have BB expansion, and it's aligned with a significant expansion like we've shown here, and price is at an extreme, we might say price is up around plus 2 or minus 2. And we can then go to the third point and say that we are seeing price action now that is triggering the beginning of the next move. So maybe it terminated in a doji up in here, or maybe it is poised to break through support and resistance, which happens to also be located at as part of this critical state. So we might say if we had plotted some resistance here and price is now approaching it, and the first thing we might think is that when it gets to that critical state, it can either blast through here onto the next move, and so we might take, half of the channel or add a third standard deviation up here and look at that price level, or go back and look at the next resistance level and map that as the first move out. So the first thing that can happen when it gets to this resistance level is break through. What I like to do is have the position in hand with an automatic entry on the far side of this, so that if it does blast through on a limit order, I'm not trying to chase it. I simply get whatever I get, and I'm surprised into the trade. Or the second thing that happens as the price comes up and starts approaching this, we get something like a Zeno stop, and now we've got this accelerating reversal back to the mean. So if we're in that position, that's certainly the Zeno type of an exit should give us a nice profit capture. We might now start thinking of this as a Zeno entrance, and that is that it got up to that critical state, failed, and now we frame the train back towards the Bollinger Band mean as the next logical price target. And so the RLCO framework now turns out to be one nice adaptive way to operationalize this, and it simply uses the regression lines to smooth price for us. But it's really more about the trade location in this. So now the next logical extension of this is if we synchronize the market itself with these sector swings. And we might say, if we were to map the volatility of the market and the sector itself, we might say, are they in sync? In other words, is there a correlation? Is there a relationship between where they are in their swing pattern? And if they are in sync, then we might let the market help us to accelerate the move, so that if you get the market plus the sector moving for you, and both looking to be in favorable volatility moments, I submit that that's going to be the time you're going to get the biggest follow through, and it'll feel very easy. We might also say, well, what if they are perfectly inversely synced, so that the volatility of one is going up while the volatility of the other is going down? And that might be the place where as the market starts to consolidate its volatility, we're looking for the next range expansions. What's expanding now? That might become the new relative strength leader on this next move. While the market and the primary leader from the last phase are digesting their gains, we now are looking at volatility expansion while the market is contracting as an indication of where the next leader is likely to come from. But if they're out of sync, and I'm going to show you an example of where the market is leading and the sector is lagging, we might actually get a heads up on a nice move inside the sector. So if the market has already made its turning point as marked off by this vertical line, but the volatility of the sector was declining and only now is starting to roll up, we actually have the difference between this vertical line and that vertical line where the market is leading the sector. And so if we see that the market is actually working, then this might actually lead to the sector starting to work here and then playing catch up. And now we might be able to use the market heads up as an opportunity to get more of the primary move in the sector. So perhaps we can get more of the sector move by watching how its volatility and maybe price dynamics relate to the market's activity as well. So these are the just some ideas here about how we might start looking at the volatility statistics of individual sectors in the same way that we've been using the risk Z of the volatility index to look for timings on the XIV VXX pair, but also to take a look at classifying the market condition itself as favorable for long side swing trades or short time day trading. My sense is that the use of the volatility statistic now as a means of comparison might give us some insights that are not easily available to people that are looking only at price charts. So I think there's a hidden edge inside here. So thanks for your kind attention. As we're into this 21 minutes already, so let me wind this up with this little discussion of volatility and swing trading in the ETFs.